The $1.8 billion pivot. A quantum computing company just spent $1.8 billion to buy a traditional semiconductor factory in Minnesota. On July 31st, IonQ officially closed its acquisition of SkyWater Technology, abandoning the capital-light, fabless playbook that built modern Silicon Valley. Overnight, they transformed into an integrated device manufacturer. The press releases claim this secures their supply chain, but the underlying profit and loss reality points to a much more aggressive play: the Tollbooth Strategy. Look past the press release narrative about fault-tolerant computing and look at the market structure. SkyWater is the largest exclusively U.S.-based pure-play foundry, holding a highly restrictive Defense Department accreditation. By absorbing this facility, IonQ didn't just secure domestic wafer fabrication for its own trapped ion processors. It effectively bought the toll booth its competitors rely on to prototype their own hardware. The Federal Trade Commission openly split over whether this merger would choke off rival access before waving it through at the end of July. IonQ now dictates who gets priority on the manufacturing line, controlling a critical choke point for the entire sector. But owning the toll booth means inheriting the exact financial anchor most chipmakers desperately avoid: the margin anchor. There is a reason companies like AMD spun off their foundries over a decade ago. Running an integrated device manufacturer is a cash incinerator. IonQ paid $15 in cash plus stock per SkyWater share to inherit a low-margin, high-capex operation. SkyWater brings actual revenue to the balance sheet, but maintaining these fabrication lines requires relentless capital expenditure. IonQ is trading the high margins of a design firm for the brutal depreciation schedules of heavy industry. They are betting that the guarantee of domestic manufacturing outweighs the massive drag on their free cash flow, which exposes the brutal math behind this $1.8 billion gamble. Forcing the arms race. The SkyWater acquisition proves that the quantum sector's bottleneck has shifted from theoretical physics to heavy manufacturing. By taking on the margin anchor of a physical foundry and securing a critical U.S. supply chain toll booth, IonQ is forcing the entire industry into a capital-intensive arms race. For investors, the valuation math on fabless quantum startups just broke. If you're backing a rival firm, you now have to ask how they secured domestic fabrication without indirectly paying IonQ or relying on overseas facilities. For operators, it signals that future defense contracts will demand end-to-end onshore production. Watch IonQ's pro forma capital expenditure guidance on their August 5th earnings call. That single line item will reveal exactly how much cash they are willing to burn to starve out the competition. Subscribe for more